attendees are in listen-only mode. And so if you are going to have any questions and answers, if you can put them in the chat feature, or excuse me, the Q&A feature down at the bottom of your screen, we'll be able to field your questions as we go along and definitely leave time at the end of the presentation for you. The program will be recorded, so if you have any fellow attendees that aren't able to make it today, you can share that information with them when we get it uploaded onto our website. With that, I'm going to ask that we start with our Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you, everyone. Just would like to remind everyone again that our Bowman, Nevada mission statement is to have our organization promote the professional growth and success of its members and their customers in the commercial real estate industry by creating and fostering an environment of excellence through partnership, advocacy, and education. I would like to thank our 2020 Platinum level sponsor, Cox Business, for again being our supportive partner throughout the year. And to Community Vision for being our 2020 website sponsor. Again, thank you for your support this year. And today we are going to have our sponsor for the October luncheon, Blue Sky, and our representative, Lori Courtney, share a few words with us today. Go ahead, Lori.
Hi, good afternoon, everybody. I am Lori Courtney. I am with Blue Sky Restoration Contractors. I am a business development manager here in our Las Vegas office. You guys may not be familiar with Blue Sky, as we were Harbro, and we recently merged with Blue Sky just recently this year. And it's an exciting time for us. We went from having 14 locations on the West Coast to basically having 33 locations across the country. So it's very exciting. Here in our Las Vegas office, though, we're still the same team with the same services. We still do all your emergency water losses to your restoration and for fire and for mold. I would like to take the opportunity to say thank you to Bowman for allowing me to introduce myself and to introduce our company. Hopefully one day we'll all be able to do this in person. I will get to meet majority of you. Until then, stay healthy and stay safe. Thank you very much.
Thank you, Lori, and thank you again for Blue Sky being our sponsor again for the October luncheon. I'm going to also share just a couple of community announcements with you. Most of you know, and you've probably seen the updates come across on our social media. If not, please check us out on social media. We're on Facebook, Instagram, and LinkedIn. But we do have our Better Together Toby Awards program coming in February of 2021. Chris McGarry with McGarry Partners is going to be our honoree this year. So we're so excited to have him join us. But I want to make sure that you guys make sure that you're signing up. We're going to do a virtual, probably a hybrid event, to be honest with you, but a live and a virtual event together. And so we're really looking forward to that. I want to send some last minute reminders for anyone that is going to be entering into the Toby's program this year, that the deadline is fast approaching. So that is coming up actually at the end of this week, October 30th. So just a reminder that if you're looking to put in your building and looking for that submission, we are wanting to have those applications turned in by October 30th. And I'm going to throw in something just different because that's how I am. I just want to remind also everyone else on our social media this week, you probably saw something kick off on Saturday that we're doing a virtual Halloween event this year. And so in order to just be something different, but do something fun, since we can't all be together at this time, please look on your social media feeds. We're looking for your photos, and it can be of you, a team member, a family member, you and your pet, but we want you to share your Halloween photos from this year with our group. So if you put in a submission, we will vote on those submissions early next week, and we'll be issuing out a $50 Amazon gift card to the winner. So be sure to submit your photo of you and your costume this year, and we look forward to seeing those entries. So with that, I don't think I have any other membership. I do. Sorry, because that's how I am. Sorry, Kara. One more. So we will be sending out probably within the next 3 weeks to the membership across the board nominees for our 2021 Bowman, Nevada board members. So look for that voting to come out within the next few weeks or so. And so now with that, I'm going to turn it over to Owen, and he's going to announce our speakers today for our program. Thank you.
Thank you, Tina. Thanks for starting us out today. I am Owen Calvin with Land Care. I am the chair of the programs committee. Today's 2021 economic forecast features John Restrepo and Kyle Nagy. John Restrepo is the principal of Las Vegas-based RCG Economics. He directs the firm's economic and financial consulting activities and is an expert in regional economics, including Western U.S. economic and market issues and forecasting. Working and residing in Las Vegas for many years, John is a go-to source for Nevada and Western U.S. business leaders and public policymakers needing objective data and independent research and analysis. For more than 40 years, John has analyzed regional economic and real estate trends in a number of complex markets, including Nevada, Arizona, California, and Texas. His many years of urban economics experience has given him a broad range of skills and technical expertise in assessing the effects of local, regional, and national economic trends on urban economies and their real estate markets. John's clients include some of the most prominent private and public Western US-based organizations concerned with development and growth. For 9 of those years, John was the director of financial advisory services of the Las Vegas office of Coopers & Lybrand LLP, which is now PricewaterhouseCoopers. Before joining Coopers in 1990, he managed the Las Vegas office of Mountain West Research, a regional economics firm based in Phoenix, Arizona. Prior to working for MWR, John was the chief operating officer of a 40-person regional planning and civil engineering firm based in New Orleans. John speaks regularly before a variety of public and private sector organizations on a wide range of topics related to real estate, lodging, hospitality, economic issues, and public policy issues. He has been quoted extensively in local, regional, and national media on real estate and regional economic matters. John has a BA in economics from the University of Louisiana. He also holds an MA in economics and Latin American studies from Louisiana State University, Baton Rouge. Kyle Nagy, can't forget about him. He's founder and director of ComCap Advisors. Kyle started his commercial real estate career in 1999 with GMAC Commercial Mortgage, an international real estate finance company. Prior to leaving and forming ComCap, Kyle was instrumental in the growth and success of the Las Vegas GMAC office and was one of the youngest vice presidents within the company. During his 21-year finance career, Kyle has successfully originated, underwritten, and closed over $900 million in loans with life insurance company, Wall Street conduit, bank and agency lenders. Under his leadership, ComCap Advisors was named Financial Firm of the Year by NAIOP Southern Nevada in 2013, 2016, 17, 18, 19, and this year. Kyle obtained a Bachelor of Science degree in Business Administration and Economics from the University of Nevada, Las Vegas, graduated cum laude. For the simple joy of learning, Kyle returned to his alma mater to complete a Master's of Arts in American History. Kyle previously served as president of the Southern Nevada chapter of NAIOP and as the chairman of the Executive Council for the Lead Institute for Real Estate Studies at University of Nevada, Las Vegas. In 2014, Kyle was appointed by the Nevada State Legislature Commission to serve on the Mortgage Investment and Mortgage Lending Advisory Council. Thanks again, John and Kyle, for your time and participation today. That was a lot of information. And, before we get into the formal questions, John, what sort of comments or data points can you bring to the surface?
In terms of the economy, I assume you mean, right, Owen?
Yeah. Let's start with some generalizations about the economy before we get into, some of the real questions.
Right. Thank you. Yeah, thanks. We look at a lot of data every month, every quarter, as it comes out. But there are some core statistics that we look at that are kind of foundational and fundamental that anyone really can look at by themselves as well. They're often reported in the media. The big thing for us is not just the unemployment rate, which is critical, but it's also the job growth numbers. How are jobs growing or not growing? That's always been critical to us. The other one that we look at is what are wages doing? What are salaries doing? And then we get in there and get kind of nerdy with it. And we start adjusting for inflation to see if salaries and wages are growing properly. And then we start looking at obviously the very specific Southern Nevada indicators. What are the visitor volumes doing? What are the retail? What are the taxable sales numbers doing? What are the gaming numbers doing? And things like that. And so house prices is another one. There's about 10 core variables that we look at either monthly or quarterly as they come out from whatever agencies or organizations putting them on. And that starts giving us kind of a complete picture of where we're heading economically.
Perfect. Well, thank you for that. And, let's talk a little bit about this term, reinventing and recovering the base economy. What does that mean to you?
Are you asking me, Owen?
Yes.
Oh,
John.
I'm sorry. I apologize. I thought you were asking Kyle. That's a great question. I think we've always talked about recovery here in Southern Nevada, and by recovery meaning how do we recover what we had before this a downturn? And in the past, that's always been what do we need to do? How do we look at, or should we? No, let me rephrase that. We have a tendency to look at the resort industry, the lodging hospitality industry, as kind of the leader of the recovery, and it has been in the past. But at the same time, I think this type of recession that we're going through right now, this type of time, a downturn, as well as where we are historically and culturally, I think we need to be talking about reinvention more than recovery. How do we restructure the Southern Nevada economy to make it more resilient to these downturns? We've learned once again that because of our lodging hospitality-driven economic structure, we're probably the most vulnerable one of the large metros in the country that's the most vulnerable to these kind of downturns because we are largely dependent on discretionary spending by visitors. They could be conventioneers, it could be just tourists that are coming here to visit. And so this whole issue of reinvention is becoming a real critical part of our discussion right now. And I think a lot of political leaders and our business leaders are trying to see how do we transform our economy as to hoping to go back to what we were doing, let's say, a year ago, for example, that kind of economic structure.
Yeah, that makes a lot of sense to try to insulate ourselves from any sort of future issues that we're going to have with some downturns. This next question is for both of you. Do you think that the lodging and hospitality industry, including pro sports, will lead us ultimately out of the recession or some other sector or sectors?
Do you want to take that, Kyle?
Sure, and thank you for the opportunity to be here today. To add on to John's point, it's not impossible. I mean, you take a look at the Reno market, and they had gaming. Granted, they're on a major freeway, they're on I-80, but they have over the past 10 years reinvented themselves. Their downtown core, their residential, their multifamily, single family, industrial, office, retail, it is now catering to a different crowd, and the market is doing quite well. Our Reno office has been far more successful than I expected when we opened it. And it's an influx of Californians, and I understand that everyone believes that's going to continue and possibly save our market and the growth is going to come from there, but they're coming and they're investing in the community. They're not just building an industrial building, taking their cash and taking it back to California, living on the beach. They're moving there, they're living there, they're putting their children in their schools. So it's not impossible as long as we offer a viable, call it different approach, opportunity than what we have provided in the past.
Yeah, if I could add to that, I agree with Carl. I think going directly to your question, will the resort industry or hospitality industry lead us out of this time? I think it was your direct question. I don't think so. That doesn't mean we shouldn't nurture the resort industry. That doesn't mean we should not have public policies and business planning that supports the lodging and hospitality industry. But I don't think it's going to lead us out of this and bring us into a brave new world, so to speak. I think we have to look at the other sectors of the economy, and we have to look at all the same things we always are talking about: tax structure, education, the quality of the workforce, our proximity to California is a big asset that we have. So I think we need to look at a different type of leadership out of this thing that may not be exclusively or primarily driven by the lodging and hospitality industry this time. If you want just one example of what I mean of that, look at the difference in the health of the economies of Reno compared to Southern Nevada. The Reno Sparks metro area economy is much healthier than we are right now in terms of the indicators. And the primary reason is because they have a more diverse economy, and they're on the I-80 corridor, as Kyle said, and they are in close proximity to the Bay Area, the Pacific Northwest. But their core advantage is that they, over time, move to a more diversified economy.
And John, you bring up a great point. And in Reno, housing prices are higher than they are in Southern Nevada. And what's interesting there is that as we move, if we do move, in fact, to a work from home or work from an alternate location in an office, you could still commute between here and Los Angeles pretty easily. And if you are required to be in the office once, twice a month, and you're able to work from home the rest of the time, Las Vegas becomes very affordable. And we don't have to create a job for that individual, but we do get the benefit of his tax payments, his and her spending in the economy, the discretionary income that goes into all the retail. So there's an opportunity to become an affordable work away from office location that our market is moving towards. And I get it. Everyone watched that show Yellowstone. They all want to live in Bozeman and they think that's the great lifestyle. But for most people, it's not. They still want to be in a central area. They still want to be close to a major airport and live in a city, get sushi, go to yoga, buy their cell phone, go shopping at Smith's. Montana's not going to work for everyone.
Thank you. I think I do all those things you just mentioned. Speaking of leadership, John, do you think that Governor Sisolak and legislature will be addressing the state's tax structure in the upcoming legislative session?
I think they will. Right now, everyone's being very careful about talking about tax reform or tax increases or whatever you want to call it, because of the election in a week from now. So they don't want to, muddy the water, so to speak, and take votes from each other. I just don't know, by looking at the state budget and looking at what's been going on in terms of the last legislative session, the special session, and the cuts they made to the education services, the healthcare services, and particularly, as you guys know, it's the most vulnerable of our population. Our residents get hit the hardest, typically in downturns. They just don't have the political power sometimes to stop that. And so I don't think you can hit those folks again with additional cuts. I think at some point, as the legislature unfolds, the session unfolds, and the elected officials start talking to the budget experts, the economists, the tax folks at the state, they're going to come up with something that's going to look like a different tax structure than we have today. What does that mean? We don't know yet. I don't think there's going to be an income tax. That's too big of an issue. But there could be reforms to whether services should be taxed, and how many deductions do we allow? Do we increase the minimums? For example, the commerce tax right now is $4 million a year before you have a commerce tax on your business. Do they lower that? There's a lot of things they could tweak. Do they tweak the property tax and have it reset to market at sale? There's a variety of quote unquote reforms I think they'll look at, because what we know right now, the tax structure that we have is very volatile because it's so narrowly based on the sales tax of products only, and some property tax. But they're going to be looking at, I think, broader tax reform at some point, for sure.
John, my question follow up on that is, will the results of the election have an immediate or near-term impact on the local or national economy?
Not really, because all of us, whether you're a red state or a blue state, or a Democrat or Republican, or whatever your political leanings are, we're all under the control of the virus. The virus we're on virus time, as has been said. That's going to control the health, the rate of the level of recovery. It's going to control a lot of things, in jobs, industries, and so those sorts of things. Until we get a vaccine that's widespread, delivered widespread, it's going to be difficult to see where we are economically. That's why I tell a lot of our clients when they ask me where we're going to be, I say, no, listen, let's wait till the mid 2021. That's when we'll see real patterns in the data, and they'll determine whether the Republicans or Democrats run things with what's going to happen. But I think right now the controlling factor is not political preference, it's the virus.
A lot of my high net worth, successful clients tend to lean towards a specific party. Mm-hmm. And I've heard from them and in conversation that they absolutely want their candidate to win, that they believe that he is the best person for the economy. But as soon as it's said, the other candidate, the one that is known to be a little more liberal, a little more institutional, maybe the one who doesn't go on Twitter as often, is considered a viable option, a viable bet, because you know what you're going to get. You understand the platform. You know where he wants to go with taxes. And I'm not saying one party is right or wrong. And again, they would prefer their candidate, but at least if the other candidate is elected, there is a institutional understanding of his direction, which provides a level of comfort. Now, granted, they may or may not pay higher taxes under that platform, but they at least know where it's going. Do you get a general sense of that as well, John?
Yeah, I think, it all depends where where the voters are right now. Are they looking for more additional disruption to the system, so to speak, or they want more stability in the system? They want more predictability, or do they just want to upset the apple cart and upset the establishment, so to speak, which was a major component of 2016. The other thing that we're seeing is that the economic recovery that we saw after the Great Recession was pretty uneven, and that helped President Trump get elected. Small towns, working class folks got hurt and didn't really recover fast enough from the Great Recession, recovery that followed the Great Recession, so to speak. So there's a bifurcated thing we're seeing here right now. This issue of being a disruptor or not. There's an urban versus rural kind of divide. There's a gender divide. Sometimes, in some cases, there's an educational divide. If you look at all the data, the areas that are doing the best right now are getting hit the least, less worse, are urban areas with large numbers of highly educated people. And so that, of course, feeds into how people vote. And it's not always just the pocket votes. There is a number of growing consensus by folks, even folks on the wealthier, more conservative side, of the issue of character of a president. All right, and it's like someone said to me the other day. I heard on a news show. I thought it was kind of an interesting. The question was, would you vote for President Trump? And the panelists, the other pundit said, you can answer that really quickly if you can answer positively to three questions. And that's one question is, would you work for President Trump? Would you have President Trump as your partner in a business? And if you had a daughter, would you let her marry President Trump? If you can answer those questions affirmatively, you'll probably vote for President Trump. If not, you may look at other options, right? And so this issue of character, I think, is playing more this time around than just merely tax cuts, I think. And so, but again, we'll know in a week, and it's going to be a very close election, very close.
And this economy is hitting people differently. I mean, you and I have talked about this K-shaped recession we're in, right? I mean, for those people that are playing in the stock market, who have invested a high net worth in the stock market, or who have investments in gold, silver, the precious metals, they're doing okay right now, right? Their stocks have increased, their net worth has increased. Those that are not invested or participating in those opportunities, the person who goes to work the normal job, many of them have been laid off, or their hours have been cut, or worse, their productivity is lower because they're at home with children that are not in private school, and they need both parents there to cover science and English and literature, whatever else they may be learning. So the economy is in two different positions for two different groups. And I don't know who shows up to vote. That's beyond my ability or understanding. but there's definitely a difference between how the economy is treating people. And what is interesting from our point of view, our vantage point as a commercial mortgage banker, is that we are working with two different groups, right? I have the high net worth, the successful commercial real estate owner who is affluent, who has great connections. And then the other group are my institutional out-of-state lenders. These are capital sources, large life insurance companies or commercial banks. So on one side, you have a group that has economists like John that are sitting on their board that are telling them what to do. And then you have another group that is affluent, that has great connections, that own commercial real estate. And what's interesting is the conversation between both of them and how lenders and we call clients borrowers are communicating today. And traditionally, these groups were lined up eye to eye. They wanted the exact same thing. That's not necessarily the case today. Lenders are taking a different approach, and the high net worth people feel that, there is some risk in the market, but this is going to continue and they're going to be okay through this. So it is an interesting dichotomy of what's occurring in the economy with individuals, and then with the higher net worth investors, and then the lenders and businesses that are actually operating and have businesses to run.
That's a great point. If I could just jump in again, Owen, on it, because at the end,
good.
at the end of the day, whether you're on the commercial building, so whether you're in business or in lending, or you're in the commercial space, you're on the business side, not the personal consumption side. At the end of the day, everything depends on consumer spending and consumer confidence, because 2/3 of the economy nationally, and probably the same ratio here in Southern Nevada, are driven by consumer spending, right? And that comes from consumer confidence. And that rate of spending also comes from wages going up after you adjust for inflation, purchasing power. And so right now, though, that the strength of the consumer in certain areas is doing okay. In other areas, for example, here in Southern Nevada, because we're dependent on low wage, low skill workers, is hurting quite a bit. But at the end of the day, you have to have the bulk of consumers, both at the higher end, the middle end, at the lower end, being able to buy the stuff we make. I always, I talk to my conservative friends, and I say, what do you think are the real long-term job creators in an economy? And the answer generally comes back: small business, entrepreneurs, they create jobs. And kind of the answer is, from our standpoint as economists, no, not really. It's consumers with purchasing power. Because if they're not buying our services and our products, it doesn't matter how great a business product you have, how you're not selling it, right? And so you need to have that overall job growth occurring with good wages happening. And so until we see that on a consistent basis over time, we're going to be going through this kind of jagged, what they call, Kyle's got the K-shaped recovery, where the well-educated are doing better and the less well-educated are not doing as well. The other one that's been used is the jagged, Nike swoosh recovery, where it goes up and down, up and up and down until it finds some plateau. And both of those scenarios, we're talking 2 to 3 years. In most cases, where we're going to see growth rates in Southern Nevada and in the U.S. back to some historical norms. And that's kind of the area we are right now in terms of our where we're proceeding through this.
Wow. Well, thank you. That was a lot of information to unpack. I think for the next question, let's talk a little bit about the Employment Lands Report. I know you recently did something over with NAIOP. Can you talk a little bit about what that is, John?
Yeah, let me kind of quick overview of that. And some of you guys, if you're NAIOP members, have probably gotten the report. And NAIOP commissioned us pre-recession, so the numbers are pre-COVID, to look at how would land shortages, if we assume certain rates of land shortages here in Southern Nevada, how would that affect economic growth? So what we did is we looked at the inventory of vacant land in Southern Nevada. We adjusted it by it had to be a minimum size, these parcels, and a minimum or maximum slope. I believe it was 7%, so it would be developable, particularly for industrial and warehouse. And then we compared that inventory of land. That land information, by the way, we got from the Water Authority. Great guys over there, very helpful. So they provided us the database. Then we compared that to the job growth being projected by the Governor's Office of Economic Development by industry, by occupation. to see the matchup, because every job has got a dense, you can put jobs per acre and all these sorts of weird real estate research things we do. And we came up with this answer, and the answer was a little scary, and that is we don't have enough land to support the jobs that we're projecting. And if we don't, and we have and growth, job growth and GDP growth and wage growth gets lowered in one scenario, let's say by 3%, and another scenario by 5% a year compared to some base case, what would that do to our economy? It has potentially significant impacts on economic growth and competitiveness, because we can't build the buildings we need to support the economic job growth we think we want to have. So that puts us at a competitive disadvantage, not against California necessarily, but definitely against Phoenix and Salt Lake and some of these other cities that we compete with. So it shows that land, which we assume is always going to be available somehow, it's going to require a lot of public policy decision making and cooperation between the development community, federal and state governments to make more land available, developable land available in Southern Nevada, so that we can stay competitive in this new world we're entering. So that's basically the purpose of that study. Coincidentally, in the middle of all of this, the county is moving forward with what they call euphemistically the Clark County Lands Bill to make more federal land available. And that bill now is in the hands of Senator Cortez Masto in Washington, D.C. And obviously, everything's been kind of put on hold because of the election, but hopefully that'll start heating up again in the spring, and we start trying to get more land so we can have a more economic sustainability in our community. It's a big concern, and I know the NAP guys are talking a lot about it. Maybe Kyle wants to speak into it from more of a lender and developer standpoint on the land issue.
And to add, John, you and I have been to DC together, waving maps and talking with our delegation. We've had the great joy of doing that. And help me understand, but by 2023, we are hoping that we'll get congressional approval to open up the Jean Dry Lake bed south to Jean, and possibly even further south to further development, which will connect us closer to California. I know the county approved it and they submitted it. So I don't remember how large that is, but that is a large piece of land that has utilities already somewhat in the area, correct?
Right. That's another piece of the puzzle. Yeah, there's the Ivanpah. You're talking about the Ivanpah Airport land?
Well, I'm talking about the Jean Dry Lake bed, and then of course the Ivanpah Airport that you and I have been beating that drum for 15 years.
Yeah, I mean, the key to our remaining competitive and the key to us being able to attract California companies here or companies from other states for that matter is, what we do with our land resources between Las Vegas and Southern California. That's the key. How do we make more land available in that I-15 corridor? That's critical because of the size of the California economy, if nothing else. And so that comes into play in a big way to us to remain competitive. We don't have the land right now like Reno does with the Tahoe Regional Industrial Center and all the land availability, for example, that Phoenix has. And so that land base needs to grow. But yeah, the southern part of the county is the key to our future, for sure.
Why hasn't, and correct me if I'm wrong, is Boulder City not the largest municipality in Southern Nevada with land, with the dry lake bed that they have that runs all the way to Searchlight? Why haven't they released that for any development? I understand it's on the I-11 corridor, not the I-15, which makes a difference in shipping, but that's a huge swatch of land that is sitting relatively unused.
Yeah, it's been really a political decision, I think, by both the Boulder City residents. Yes, they're very fortunate. They have a lot of land that's been given to them by the feds. Right now, to get any kind of, as I understand, to get any kind of really large-scale development going on down there, it's got to be by a vote of the public. It can't just be done by the city council, for example. And they just have traditionally always been somewhat of a, we'll let the growth occur in Henderson, we'll let the growth occur in the urban parts of Clark County, but we want to be more of a bedroom community. We want to be a small town. We want to have a small town feel. And therefore, there's been resistance by the residents on making too much, having too much employment land, so to speak, in Boulder City, because it's going to create growth and infrastructure issues and all those sorts of things that they don't want. It's kind of more of a political, philosophical thing that they've had for years. It's been like that since I moved here in the late 80s.
And we've had land or homes in Boulder City as a family since 1980. So we've experienced it. And now with I-11, there's there's all these opportunities for exits off of that freeway. They could be wonderful locations. And maybe to answer or to spin John's perspective into why it matters to you as members, as consumers and residents of services here in Southern Nevada, when land is unavailable and it becomes more expensive, remove development costs, remove profit, remove everything else, and let's just talk about the component of land. And I'll put on my developer hat and then I'll move it to financing. When that land becomes more expensive, that property becomes more expensive to build. And when that property becomes more expensive, the only way it makes sense is by obtaining higher rents. And higher rents lead to less viable services, leads to smaller spaces, it leads to density. It also leads, and put my lender finance hat back on, to a higher price per square foot in value and a higher loan per square foot on a basis comparative to other markets. So for instance, I have a national lender who has now become interested in Nevada, Southern Nevada, and says, I'm willing to lend in Nevada for the first time in X amount of years. And then we bring them a transaction. And because of land use, that transaction has a loan of $150 per square foot. That lender is going to say, I could lend in Omaha, or I can lend in Southern Nevada. And in Omaha, that same property, that same risk, that same profile is going to be at $100 or $75 per square foot. But in Nevada, it's going to be $150. That lender, which we need in our economy, which we need as an outside source, is going to choose to remain in Omaha and Des Moines, or he's going to take the risk in Southern California where the economy is better diversified and where the economic base may be stronger. And just to give you a little perspective, 20 years ago, the vast majority of commercial financing occurred or were closed by Nevada-based lenders. We're talking 90, 80% of the market, the loans on commercial property were from Las Vegas, Reno, Nevada banks. I pulled some numbers. In 2019, December, 70% of the commercial loans, industrial, office, retail, self-storage, multifamily, loans above $2 million, 70% of those were funded by out-of-state sources, life insurance company, out-of-state banks, conduits, commercial banks, capital sources that are pulling money together, family wealth funds, 70% in December. And in September of this year, right while we're going through all this COVID, that number back down to 62%. We only lost 8% of our national lenders who said, hey, Vegas, Reno, Nevada is a little more risky than we would like. We're going to focus elsewhere. We need to continue in that direction. We need to bring more out-of-source lenders into our market. They increase competitiveness. They offer very favorable terms. They offer a different product than the local bank. This was not the case in 2009, 2010. All of these out-of-source lenders, they left. They went to Omaha. They went to Des Moines. They went to Kansas. They went to San Francisco. They went to places that were better diversified, deeper economic bases, and we could not finance property. People were losing properties. They couldn't get bridge loans. They couldn't build properties. They couldn't save their properties. The lending sources on a national level dried up. We have to continue being a viable market through a strong economic base and invite out-of-state lenders here.
Thank you, Kyle. It actually leads me to one of my questions is, are developers and owners capitalizing on the new interest rate environment?
Well, our rates are lower than they have historically ever been. And that's artificial manipulation by the federal government, by all the parties involved. And John will probably give you cap rate and why it's important. But for the first time, rates are at a point where lenders are saying it's not viable for us to lend money anymore unless you give me a compelling reason. For instance, on a 10-year fixed rate, 30-year amortization loan on an office building, you can get a 3.25 rate today. 3.25. I mean, at the top of the market, 2006, I was happy to be under 6%. I was 5.9 and we were dancing in the streets. You're talking about a 3.2% rate. So projects that were not viable are viable just because borrowing costs are lower. Are borrowers taking advantage of it? Yes, they are, if they can. If their property is performing and they pass the COVID checklist, which basically means that the tenants are in, open for business and paying rent, borrowers are taking advantage. I ran some numbers on our portfolio. Of the 313 loans that we have quoted year to date 2020, 22% were acquisition. These were new people coming into the market looking to buy commercial properties. 64% were refinance. Again, people looking at their portfolio saying, I'm paying 6%, call Kyle, I need to get 3%. I think that number on the refinance would be higher if the properties justified a refinance today, meaning all their tenants were open for business and paying rent.
Wow. Thank you. Are you seeing a rise in loan payment delinquencies or requests for loan forbearances?
Good question. As a servicer, one of our roles that we have is we collect interest payments, principal interest, taxes, insurance, tenant improvement leasing commissions on the loans that we close. Our current servicing portfolio is around $490 million of loans in Southern Nevada. At the height of the outbreak, the pandemic, call it March, April, of the 6.3 million square feet in the portfolio, 15% asked for some level of forbearance, which either is a principal forgiveness, principal delay, principal, call it a deferral, or an interest deferral. 15% of our portfolio. Of that 15%, 90% were retail properties. Office, industrial, multifamily were doing well. For comparison purposes, we are a part of a much larger mortgage banking group that services $17 billion throughout North America. We add our servicing portfolio to theirs, total $17 billion. On the average across the entire portfolio, the deferral or the forbearance rate was 17%, which means Nevada at our 15% level was performing better than national. I am pleased to report of our entire servicing portfolio, we currently do not have one borrower in default. And we've only had one forbearance request for an extension. Everyone we granted March, April, May is either currently in it or have moved to a full payment. This is far different than what we experienced 2008, 9, and 10. Borrowers are sticking with their properties and banks and lenders have been a little more accommodating than they have in the past.
Wow. So, how confident are small, medium, and large clients about the current state of their businesses relating to what you just said?
Well, of that 6.3 million square feet, that's a lot of businesses: retail, office, industrial, self-storage, multifamily. What I find is interesting about our market compared to, say, a Phoenix or an LA, and John and I have talked about this a few times, is that in LA and Phoenix, you have regional headquarters or you have these large headquarters. And in these businesses, they've said national mandate, everybody goes home. And individuals are working from home. And this has been a factor that's hurt our office market when we try to bring out-of-state lenders, because they'd say, oh, you got a bunch of companies like RCG Economics, you have Comcap Advisors, they're 10 employees, they're not big companies. Well, today, those big companies aren't back at work. And in fact, they're deciding how they want to manage their footprint. How many office spaces do they really need? Whereas John's company, my company, we're back at work. All of our employees are back and we're paying rent. Now, granted, we're facing a different economy, but we're back. We are working in the office, we're working together, the office buildings are occupied, tenants are paying rents, and we're trying to figure this out. So with that, our small and medium companies seem to be back and feeling a little more optimistic. Our larger companies are preparing for the downside. They're looking at how much square feet do we need? Can anybody and can everybody work from home and for how long? And they're a little bit more, I'd say this, how can I say this politely? They're not in panic mode, but they're in preparation. What happens if it goes bad? And then you take a look at the small, medium developer. The large developer is managing their portfolio of tenants. They're offering some rent forbearance. They're offering opportunities to work through. They're not putting the hammer down on small tenants that can't pay rent. They're trying to work with them. The ones they're not helping at all are the ones that just disappear in the middle of the night. They're definitely going after them for past rent. So on an optimistic scale, it feels far better than it did 2009, 10, and 11. The small companies are trying to figure out, the big companies are trying to prepare, and the medium companies like John and I, we're back at work trying to do business. John, would you echo that based upon your consumer sentiment and consumer confidence in your business reports?
Yeah, I think so, Kyle. I think you said it pretty well. I think the big difference this time around, we at the federal level, I guess you want to call it that, or at the national level, we learn what not to do in response to a recession. Last time around, the 2007, 2008 recession, remember, it lasted about 19 months. It started in December of 2007. we did not have these safeguards in place. We didn't really understand how the economy would react, how businesses would react, lenders would react, and there was not enough safeguards put in place early enough to limit the decline. And so this time around, and Kyle mentioned it earlier, the Fed got very involved, the Federal Reserve, and lowered interest rates dramatically. For example, the Congress then passed all the federal stimulus dollars, the PPP money, the EIDL money, and the eviction moratorium and all these sorts of things. Some have worked better than others, but overall there was more involvement by the federal government to manage the depths of this downturn. And that, for example, improved confidence, right? And it helped people say, okay, we're not being left alone here. So there's a safety net both for individuals and businesses. And so the question is the Congress, well, right now, we know they're not, but will ultimately after the election be and the White House, whoever is in the White House, be more amenable to another large case, another wave of stimulus, another large tranche of stimulus, which is probably in and around the $2 trillion range to keep this going until we get control of the virus and get the vaccine out there and widespread. So there's going to be a continued amount of government involvement, some people call intrusion into the economy, but I don't think they had a choice. I don't know what you could have done at the beginning of this recession, as Kyle mentioned, the March, April standpoint, when things dropped, when we went from a 3.5% unemployment rate here in Southern Nevada to 30%. We're now at 15. It's probably closer to 20 when you really count everyone. So these are really high unemployment rates, and so it's going to involve a government involvement for a while. This is kind of what it's been taught in economics for years, where you need government spending to prop up a weak economy. Now, like I said, since we're on virus time, it makes it even more important. So all the things that Kyle says is absolutely true, and the reason people are feeling comfortable or confident or less nervous, the lenders, the developers, and that sort of things, they feel that there's some kind of safety net that can help them get through this. And so we'll see. Again, a lot of this, we'll see the proof will be in the pudding a year from now, let's say, or next summer. And we'll really see how smart the feds and the Congress was providing all the stimulus. We'll see.
John, you've studied economics a long time. This feels like a wartime economy. The way in which the government is spending through the deficits they're running, the imbalance with trade, the manufacturing, the stimulus to certain types of business. It feels to me like a wartime or post recession economy. You agree?
Right. Yeah, I mean, if you want to go back far enough, when the Great Depression started in the 30s, the thing that pulled us out of the Great Depression was World War II. Mm-hmm. Not that it was necessarily World War II is a good thing to have happened. That's not exactly the preferred way to stop a recession, but the government had to, spending in World War II, putting people back to work for the war effort and all these sorts of things helped end the Great Recession, the Great Depression. Obviously we had to go into World War II. And then following World War II, because what the government learned about investing in the economy, so to speak, whether it's here or in Europe, when they did the Marshall Plan in Europe to save Europe after the war, we learned that there is a role for government in deep downturns, and that role is to limit as best we can the economic pain, because the economy, when it gets hit too hard, there's always going to downturns. There's always cycles, economic and business cycles. But when it gets hit too hard, it's very hard for the private sector economy to heal itself, right? I hate to use the term, it needs a vaccine. And the vaccine is large infusions of money and funds. And that leads, obviously, potentially to inflation and to higher rates of debt. But I don't know how you could have done this otherwise. But yeah, we are in that kind of economy right now, because what we learned this time around too, and I'll be quiet, and that is how linked we are to the global economy. And so whatever happens to us affects Europe and Asia. What happens in Europe and Asia affects us. So we're all kind of linked in together. And so, which requires in many ways more government involvement in economies, whether it's here or in Western Europe or Asia or wherever we're talking about. So there's a very kind of intricate system here of government investment and private sector investments can be with us moving forward. The final thing I'd say, which makes this recession unique and how we're going to come out of it, we haven't talked about this much today, is the whole issue of technology and the advances of AI, robotics, and that sort of thing in terms of AI, meaning artificial intelligence, how that's going to affect how we work and how how productivity in an economy is defined, and that's how that's going to affect jobs. And there's all kinds of things at play right now that are just unfolding.
Wow. Well, that's definitely a lot of great information. We have about 10 minutes left. Just real quick, John, before I take, I think only one question that popped in. What keeps you up at night?
You know, the big thing that keeps me up at night, to be honest with you, Owen, is that we in Southern Nevada don't learn from what we're going through right now. That in a couple of years, things will start, or 3 years, whatever the period is, we start getting back to some sense of normalcy in terms of growth. And we put it on the back burner a little bit, improving our educational system or diversifying the economy or looking at our tax structure and becoming more resilient and sustainable by doing things differently. That we put all that on the back burner because, you know, we're back again because they open another resort, for example, or whatever it may be. And that's my concern, is that we don't learn from this, that we have a fundamentally very vulnerable economy that needs to be re-engineered, reinvented, so we can become have a more sustainable life here in South Nevada. Now, the good news is that we have the creativity, we have the resilience here as individuals and as the community and business leaders to change things, to look forward, not backward. But it's going to require a lot of heavy lifting, and I like to say this all the time, a lot of time, talent, treasure, and political will. We can do it if we put our minds to it, but that's what keeps me up at night, that we kind of forget what we're learning right now and go back, you know, to the old views that, you know, Vegas is a, you know, remember when we always said Vegas was recession proof or recession resistant? It was never really true, but it was a good story we told ourselves for many years.
Thanks. Kyle, do you have any thoughts? What keeps you up besides your gals in college? Besides your kids in college?
Thing that keeps me awake, so I have 3 daughters in college. That of course is on my mind. You know, I have a really weird approach to life. I'm an economist and a historian, and I would say I'm a little bit of both, but not an expert at either. And you know, the part that keeps me awake is that I often fear that people forget what it means to be an American. And I don't want this to be some political statement, because it's definitely not, but it's not about a red or blue. It's not about this candidate or that candidate. Being American was always about having hope, and it was always about following or building the American dream. And it didn't matter how long you were here, and it didn't matter where you came from. You were American if you believed you could improve your life by going to work every single day, and sometimes doing the stuff that nobody else wanted to do. And you're supposed to work at a minimum 2,080 hours a year. That's a full-time job. And what made us different is that very few people work 2080. They work 2090, 2,100. They work a huge amount of hours. And the part that keeps me awake is after this election, people will resort to their individual beliefs, their individual parties, their individual ideas and goals, and forget that we are all in this together. And that being American is not about where you're from, what you do, what state you belong to, how wealthy or affluent or who you voted for. It's about rolling up your sleeves and going to work Monday morning. And then Tuesday, Wednesday, Thursday, closing your mouth. And when you win, you don't celebrate. You just do it again the next time over and over. And I fear that our community and our country is losing that ideal. And that we have started to define ourselves based upon what our individual beliefs are, rather than what it means to be truly American. I'm sorry, that's not a political statement, but that's the part that keeps me awake at night, if you really want to know.
Well, I asked. Thank you very much for that. Let's see what our question is. So when do we change our development model to have more density? Now we sprawl, and in older cities, we see 2- and 3-story industrial and reuse big empty projects for different uses. Density will help many of our infrastructure issues as well. That's from Dave Ray. Does that make sense?
John, you're the economist who's on the NAIOP board still. You want to address that from an industrial point of view?
You know, yeah, That's what it kind of ties in with Dave. Dave's a great question. It ties into where is technology heading in the commercial real estate industry? How is it going to affect how space is used? Where jobs are created? Where companies want to be, for example, where they want their employees to live, and all those sorts of things. So these multi-story industrial warehouse models that are being looked at right now in highly urbanized areas are kind of an interesting thing. Again, we're at this beginning of a very transformative time in our history, both as a real estate industry and as Kyle so eloquently said earlier, as Americans. Where are we going? What are the values that we have? How do we work together? How do we commune together in terms of travel back and forth? And how does the economy change? Because now everything's driven by AI and robotics and technology that's going to make some of these kind of repurposing of commercial spaces more interesting, particularly as you mentioned earlier, this idea of multi-story warehouse. That's only doable because of technology, right? And robotics and other things. Now, there are downsides to that, at least in the early stages of these transformative periods in American history. We're now what economists call in the fourth industrial revolution, which is the robotics thing. And through all these other three revolutions, we went through these industrial revolutions, there was turmoil and dislocation for a period of time until the culture and the economy adjusted to this new technology. So we're in the beginning of I think a long, interesting, scary sometimes process. But I think if we hold to our values and work together, as Kyle was saying, and keep looking toward the future, we're gonna get through this. As long as we understand it's gonna take time. It's gonna take a lot of effort on all our parts. But I think that issue of how land is repurposed and buildings are repurposed are all part of this discussion as well.
There's
Perfect.
several factors that go into that, John. To your great point, every industrial revolution has led to a massive job loss and a cultural change, right? When something changes, people are dislocated. You no longer need as many people on the fields and in the farms when you're able to drive a tractor. You didn't need as many people in the assembly line. You don't need as many people when robots are doing it. So it requires almost a retraining of an entire workforce. And you're now not just replacing a workforce with AI and robots, but you're eliminating a whole way of thinking, a whole factor, a whole component of capitalism. So I think that's absolutely interesting. And to answer the question very directly, it comes down to the land cost. As John and his group is more and more successful, we're able to gain land in the Jean Dry Lake bed, as we're able to go south towards Prim, as we build out to Apex and North Las Vegas, and the county brings out utility, land costs are going to remain reasonable. And in that, you don't have to build an expensive 3-story industrial building unless it's necessary. And to add to the whole urban sprawl or to the urban density, when your company says you don't have to come back to work, you might not move to Bozeman, but you know what? Coyote Springs may be viable once again. You may move out by Kyle Canyon and you don't have to live down by your office anymore, and you could still get the resources, but you don't have to be in the urban core. So I think all of those factors could greatly impact, the way that this moves forward.
Wow. Well, thank you guys. I am unfortunately getting the hook. We have only a couple minutes left. So thank you again for joining us. I'm going to turn it over to Tina. She's going to transition us and close out our program. Thank you both again for joining us today.
I agree. I tell you, this was a very informative discussion. So I'm going to share with you guys just my quick takeaway, because I thought Caroline had a lingering question, but I think this might help. So my takeaways from John, and forgive me, I'm looking at my notes here, is that in order for us to not repeat the cycle again, because I'm with you, I want us to learn from our lessons. So us as Las Vegas or Southern Nevada, in order to learn from the lessons that we take away, we need to really kind of robust and reinvent our education system so that we're attractive to other markets. We need to still diversify. Yes, gaming is awesome and it helps us, but we still need to diversify our economy here and look at our tax structure. So I took those as some of those takeaways there, and that it takes all of us to invest our time, our talent, our treasures, and our political wills in order to help that. And also to kind of then wrap up Caroline's question, I think one of the great takeaways that I got from Kyle was that lenders aren't jumping ship on us like we saw probably in the last time that we were having the economic downturn, that they are still interested in our economy here. And so knowing that, if 62% of out-of-state lenders are still interested in coming to Southern Nevada, that's what's going to help us to stay strong and help us to still get through the economic recovery that we have. So I hope I wrapped that up correctly between the two of you. So it was just an absolute wonderful discussion. So I thank you both for your time and sharing your information today. Before we wrap, because I know we're super close to 1 o'clock here, I want people to stay on for just one more minute and help me. I do have a prize raffle drawing to give away for our attendees today. So Tara's going to spin the wheel for us. While we're doing that, I don't know if you guys can see in the discussion down below, everybody says great information and thank you for sharing. All right, Alyssa Rosen, congratulations. You have a $50 Amazon gift card coming towards you. So thank you for joining us today. And then before I wrap, I have two other items. One, I forgot at the beginning, and Farrah so nicely reminded me. If you are a principal member or you have someone that is looking to become a principal member with Bowman, Nevada, we still have extended that discount rate for principal members through the end of the year. So you need to take advantage now. Now joining will actually give you better benefits and give you more time to enjoy what we have to offer here at Bowman, Nevada. So reach out to Farrah on the membership committee and she'll be able to help you join. And then next month, I just want everyone to know that we are going to mix it up just a little bit. And so instead of just having our webinar luncheon, we're going to make it kind of like a Taco Tuesday. So this will be also a virtual event. It's going to be something cool. Owen and Terry are working on this right now, but we will have where you can cook along with us and do tacos and have a signature cocktail. So that is going to be November 17th at 5:30 in the evening. And that way, so people, if they're working in the office, they can join us and have time to get home, or those of us that are still remotely working can join. So I'm thinking that's going to be a great event for us to kind of help wrap out the year. If you have any questions or discussions, please reach out to us. And I think Tara's going to change the slide. If you see something that's interesting, please post it on Bowman, Nevada. We want you to make sure that you're looking at the social media sites for us. And don't forget to join in on our Halloween virtual contest this year. And with that, I'm going to close it out and say thank you so much for joining us today. I really appreciate your time.
Hey, Tina, could I jump in real quick? Tina, could I jump in real quick? I'm sorry, I forgot to mention, I'm sending Owen later today a slideshow of some of the data and information we talked about today. You can pass it out to everyone in attendance and to the BOMA membership. And I was remiss in thanking you guys. I know Kyle did, and I didn't get a chance to. Thank you guys for inviting us today, and particularly Cara Carr, who reached out to me a few months ago and asked me to be here. So thank you so much, and I want to make sure you guys get the slideshows. Thank you.
I appreciate that. Thank you for sharing that. And thank you both for joining us. Wonderful. Please take our survey as you're checking out today. We want to get your feedback. Thank you, everyone. Have a great afternoon.